Carl Buell with Navocate Business Sales and Acquisitions. It's 1 minute after 1, so why don't we just start here? We'll probably have some people joining in as we progress throughout the event here. This is a Navocate Webit. Our Navocate Webit promises cool content fast, so we want to get you in and out in about 30 minutes on your way, except for Q&A at the end, which is certainly voluntary. Our Webit mascot is a copyright of Navocate. Some general information. Attendees are in listen-only mode. If you have any questions, and we do encourage questions, please type those into the Q&A box on your panel on the right side of your screen there, and we will do Q&A at the end, time allowing. We are also recording this session, and because of that, your participation in the event represents your acknowledgement that we are recording and your agreement to participate. With that, let's introduce the speakers. And Mr. Boaz, your microphone is live.
The guy who just spoke is Carl Buell. Carl is the founder of Navocate. He was a Fortune 50 executive who also sold and owned his own companies. He's been an advertising executive with General Mills and McDonald's, among others, and was a former Microsoft executive for 7 years, doing from business development all the way to the last 2 years spending as a government affairs official for Microsoft.
And that was Boaz Vinograda. Boaz is a former president and CEO of several technology and medical device companies. He has started and grown those startups to 30 million and 100 million range in sales, has participated in 3 IPO exits, including 2 companies on the NASDAQ exchange and 1 on the Swiss exchange. So again, welcome. Thank you very much for joining us this afternoon. And again, our goal is to get you in and out in about 30 minutes. First, a very quick, brief sponsorship announcement. Our company is Navocate. It's a combination of navigation and advocate. And we provide business sales and acquisition services for privately held, entrepreneurial-owned emerging companies with revenues up to about $25 million. We focus on the underserved market segment above business brokers and below the investment banks. We represent sellers, buyers, and owners who want to grow their companies through private equity relationships. Our comments today reflect the opinion of management, but do not represent official recommendations. Please consult your attorney or CPA before making any decisions, and your mileage may vary. And now I'm going to hand this over to Boaz, who will take us through the agenda. Boaz?
When you prepare your business for sale, you're really packaging it in a way that will be attractive to potential buyers. And this is obviously crucial. The next thing is, now that you have something to show buyers, you want to be talking to them in their language as opposed to telling them stories about your experiences and war games that you went through growing your business. You want to target specific buyers. You probably want to keep the fact that you're selling your company confidential to the extent possible in order to avoid inside turmoil and deter customers potentially, and certainly employees from doing their best. And so you want to really look at who is going to be the best buyer for your business. You want to market the business to the world, but you want to keep it confidential. And you should consider using an intermediary when you are negotiating and trying to market your deal. So how do you prepare your company? With the idea that you want to maximize the exit value of or the sale price of your company. And to do that, you really need to start thinking like the buyer, the same way that when you think about your business and what it does for customers, whether it's a service or a product. You're trying to think, how are they going to use it? And that's what you cater to them. Your seller instinct is to talk about your business and try to get them excited about the things that made you start, grow, and reach, and spend so many years with this endeavor, usually. What you really should do, and that varies for each one of the buyers you meet, is try and meet what their motivation and interests are. You need to understand what their level of ability is to understand your business, because if it's a technology business, is it an engineer, is it a chemist? If they are not, you need to go into a more general terms as opposed to drilling to the technology. If it's a distribution business and people come, or your buyer is coming from a non-distribution background, you have terminology you want to avoid. Most importantly, you're trying to build trust with between the buyers and the seller, because if they don't trust you, likelihood is they will cut off the process. Buyers are talking to you when you're trying to sell the business because they're looking for a way to make money. And buying your business for them is show me the money. They want to verify that your business cash flows, that it's really profitable, and that you can leave the business without the business shutting down the day after you left. And obviously, they want to make sure that they're buying it at the market fair price. So talk about the business value is usually talking about the financial reports that you are using in order to describe the business. If your financial reports are not generally following generally accepted accounting principles, then really when you say gross profit, EBITDA, operating profit, net profit, is it really something that they understand? It's just you give a name to a phenomena or a set of accounts that does not really qualify in the general term of accounting. You need to bring 3 years of tax returns. This is one of the most important things to do because people assume you don't inflate your sales when you report to the IRS. You want to have, unless it's January, you want to have a year-to-date P&L that will let people see that what happened in the last 3 years is also happening in the last few months of the business, whether it's growth, whether it's stability. They want to be able to assess that. You want to show an accountant-prepared cash flow, and again, a third-party cash flow helps them understand that the business is actually making money and allowing you to take money at the end of the year or the quarter. Last, they do need to see a recent balance sheet because that's, among many other things, the main source of seeing what kind of debt do you have, how much of it needs to be carried over to the new owner, how much of it needs to be paid off during the time you close the deal. Why is business plan such an important factor? If you think about it, you're packaging something for sale. So the better you package it, the more attractive it looks from first go, and the more structured the information you give, the less likely you are to create false expectations that are being not met later on during the due diligence. So from the get-go, you want to show a structured and complete look of your business through the business plan. But most of us entrepreneurs avoid doing it because, you know what, it takes so much time, it is complicated, and we're about doing the job, not about writing reports and stories about it. And so oftentimes we end up avoiding the strategic thinking that business plan forces you to go into, and we end up running in place. With a business plan, you can show where you've been, where you are today, and what can be done and what are you planning to go and how you're going to grow your business, which to a strategic buyer or any buyer looking into it can say, okay, I can take over this business and build upon it. Without a business plan, basically the business is in your head, in your know-how only, and you are leaving money on the table because people find it difficult to evaluate what is it that is in your head. As a result, oftentimes when you leave, the business cannot be transferred. Carl, would you like to take over?
Sure, thank you. So far, we've talked about two things to prep your business. The first of all is speaking the buyer's language, which is primarily financial and not talking about your war stories from the past. And the importance of doing a business plan, and I think the key thing there is it doesn't have to be a 30 or 50-page document. It can simply be something in writing that defines where you've been, where you are, and where you're going to help transfer the business to a new buyer. Once you've completed those steps, now one of the things you want to think about is how do you target the optimal buyer? And we've thrown in the kicker here versus entertaining tire kickers. We wanted to talk about that because it's a very interesting part of working with buyers. So we turned to the Urban Dictionary at urbandictionary.com to look up their definition of a tire kicker. And here it is. We've added in the light blue text some of our own comments. So a tire kicker is a person who acts like or thinks they're interested in purchasing a business that they can most likely not afford, or, as we have added here, are psychologically unwilling to buy. What do they do instead? They spend the majority of their time trying to find things wrong with the business. Now, I really like this definition because of the phrase, thinks they're interested in purchasing. So I'm just going to underline that here. The reason that's so important is because these tire kickers sound like they're very interested. They probably may even have the money to be able to do the cash injection. They sound articulate. But if this is your first business sale, be aware that there are professional or pseudo buyer prospects out there. We call them psycho buyer prospects, who honestly think they are astute, legitimate buyers, but who will never commit. And emphasis on never and ever, because there are really some psychological issues there to prevent them from going forward and making that decision. But the trick is they will fool you and they will dupe you and they will lead you on because they often have very engaging personalities. They always ask great, penetrating, insightful questions. And as you're going through the process, you think, gosh, this is only a question that an insightful buyer would really ask. So how do you identify a tire kicker? Basic instinct. Your trust meter is your guide here. So you're going to be likely at early stages of discussions. You're going to be pre-term sheet or pre-LOI. And the buyer is going to appear to be qualified. He or she will be asking some very insightful questions. And then everything is fine until this question pops into your head, which is, when are these questions going to end? And that really is one of the key indicators. So how do you ask, or what questions do you ask to screen out one of these tire kickers and separate someone who's genuinely interested and capable both professionally and psychologically? Well, the first question is, have you owned a business before? If they haven't, you're dealing with someone who really doesn't have the experience to acquire your business and to pick up from where you left off. Another key question is, what are your acquisition criteria? Now, just like we're coaching owners on the phone today in preparing to sell their business, you have to think in advance, you have to prepare in advance, and the more prepared you are, the more successful you will be. The challenge in asking this question for a tire kicker or someone who's not interested is likely they may not have acquisition criteria, and you're liable to get a blank stare. The third question is, how long have you been looking? If the answer is in terms of years or decades, that's certainly a key sign. How many businesses have you looked at? If it's more than 5 or 6, that's a key signal. And the final question is, why haven't you purchased anything? This is a key question to understand what's going on in the psychology of the buyer, of the tire kicker, and likely you will hear, why haven't you purchased anything? The answer is going to be because there were problems with the other businesses. So these are really 5 key screening questions based on our experience. So I'd like to turn this to Boaz now, who will talk about how to target the optimal buyer. Boaz?
And you really don't care if they lead. But truly, that's philosophical and not practical. Because in practicality, the people who pay you the best price are the people who are likely to benefit the most from the fact that they own your business. And if your business has a very specific niche it is involved in, whether it's technology, whether it's supplying a specific item to a very specific industry, for example, some chemistry to dentists, or something in that environment, then your customers and suppliers or competitors will usually be the people who really understand that market enough to understand the value that you suggest. And oftentimes, they will give it higher value than the common person out there who has the money to buy your business, but really doesn't have the intricate knowledge of the market and the way it operates and what is the specific value and how big is that value that you provide. Networking is the next step. You know, we all network, we spend time in those events, and we find out people who are specific. A good example of networking would be to, if you have a manufacturing business, you would go and try to network at the Manufacturing Association chapter next to your, or the closest to your locale. And that's a great thing. The next thing to do is to use a business intermediary. And I'm not trying to promote this section, but these intermediaries, all they do is buy and sell businesses. As a result, their network is much extended compared to yours, number one. Number two, if like us, and most of us are members of the Florida Business Brokers, there are more than 4,000 brokers, members of this association. There are similar associations elsewhere. The way we split the fees, if any, is given, and so now you have 4,000 other intermediaries working for you by the sheer fact that you signed just one of them. So again, the exposure is much greater, and it's a group of professionals that know who to talk to and who not to. You can subscribe to database. This is extremely effective, especially if your business is not making too much money, needs a turnaround, and you want to look at the leverage buyout firm. You go to PitchBook, whatever the sign-up costs, about $10,000 or $20,000 for the database. But now you really can go and see who invests in companies like you, who wants to buy them, and you find the name and you communicate it to them. If you're going to a larger database of much greater potential buyers, Hoover's, which is an online available database that is part of the Dun & Bradstreet, can be fantastic source of data and contacts that you can find buyers out of.
Okay, great.
Carl?
Yes. Now, marketing to the world, there are 10 key steps or 10 key phases to selling your company, and we've talked about some of them here. I'm just going to list them here, but this actually will be the subject of our next webcast in February. The first step is developing the financial package with all of the things that we talked about at the beginning. Then developing a valuation. We have a separate webcast that we have done about valuation, and that's on our YouTube channel. We'll probably be doing that, I think, again later this year. Targeting, we talked about a little bit. Then developing an offering memorandum so that you have a package to present to a qualified buyer prospect. We also recommend at step 5, before you get into marketing, developing a due diligence package up front. This is going to include all of the information that a qualified buyer is going to ask for in significant detail. The reason for doing it up front is because as you get into working with one or more prospects, communicating and negotiating with them, you are not going to have the time to develop this information that you have now. Then we get into actually marketing, then managing the prospects who come in. The financing step is a big one. How is the deal going to be financed? When the financing is committed to with a commitment letter, then you get into a project management phase to eliminate the legal and financial conditions that must be done before you can get into closing, and that leads to the 10th step, which is closing. So in terms of marketing to the world while maintaining confidentiality, here are a dozen websites that you can market on. There are dozens more. These websites make it a lot more easier to obviously market to anonymous prospects than it was in the past. Different marketing websites are more effective for different types of businesses. And what we tend to do is test where our best response rates are. Again, it's not the particular website, but it's the preparation that will make you successful. Before you start to communicate on these websites, you have to define your message strategy, what's your headline to attract a prospect, what's your copy, and what is your response path. Finally, we'd like to talk about the importance of an intermediary when negotiating the deal. And when I say intermediary here, it could be us, could be somebody else who is a business intermediary, but it could be just a business associate who is either a close friend or a neutral party. It might be one of your service providers, such as an attorney or someone like that. But at this stage, when you enter negotiations, an intermediary is pretty important. In today's era of information overload with poor communication, I'm a bit of an amateur lexicologist, so I wanted to look up the origin of the word intermediary. And like so many of our words, this one has a Latin origin dating back to the early 1600s, the medieval version of Latin. The word was intermediatus, and that essentially means someone who's in the middle or someone who is a mediator. When the stakes are high and positions get entrenched, you really do need someone to help you to bring about that agreement. So let's look at negotiation as a goal. The goal of negotiation is a prudent, pragmatic, workable outcome reached efficiently and amicably. Those are all key words. Let's just take a look. Prudent, pragmatic means we're not going to spend a lot of energy. We want to get there efficiently, and it needs to be a very workable deal. It needs to be a workable outcome for both parties, and you have to get there amicably. You cannot ruin or destroy a relationship on either side if you want to have an effectively negotiated deal. The problem with that is our emotional wiring. We're wired as both left brain and right brain, and oftentimes very simple questions we take as criticism either of the business or of me or of you. That's not how they're meant, but that's how we're wired to take them, which is why owners are not in the best position to negotiate their own deal. So let's take a look at a key problem here, which is that there are two basic approaches to negotiation. Those are the cooperative approach or the collaborative approach. The collaborative approach, somebody is yielding, they make concessions, they're trying to get to the middle, they try to build trust, they make offers in an attempt to get to a fair agreement. On the other side, we have the adversarial approach. And we've all met the adversarials. They apply pressure, they enjoy doing it, they demand concessions, they trust no one, they threaten people, and the objective is not to reach a mutually beneficial agreement, but instead to win. So when you have two approaches like that, reaching the goal of a workable outcome that's efficient and amicable is very difficult because you have a barrier between these two different types of approaches. So that's where an intermediary, whoever that may be, really comes into play. Negotiation is like playing a fine instrument. It takes practice to get better, and it takes practice to develop nuance. So that's why I start the process, and Boaz comes in later to clean up. That's a joke. The importance of an intermediary, again, when negotiating the deal, is the intermediary acts as a conductor, conducting the players to bring everything together in harmony and in a reasonable time frame. One final importance of an intermediary, and at this point we're talking about a business intermediary, is time. The owner needs time to manage the business from day to day and keep the business moving. We revealed these 10 steps. Each of these steps is a distinct stage. Each is sequential, each is very detailed, and each is very time-consuming. So to go through all of these stages and continue to manage the business is often a very difficult process. So we are at 28 minutes out of 30. At this stage, we would like to open this up for Q&A. If anybody has any questions, feel free to type them into the question box.
There's a question about how long does it take to sell a business, typically with or without an intermediary. And that's really a question of how much of the person who's tasked with selling the business. If it's the smaller the company, the more likely it is to be the owner. Larger companies of the 20 million range, 15 million range may have a business development or a vice president that can be trusted to do some of the work. But if you have to run the business while you do that, and you need to develop the tools, whether it's to search the web for a format of a memorandum or go set up a meeting to get your lawyer to prepare an NDA for you so you can release the full memorandum. How often do you do a one-page that describe your company? The amount of time, if you can afford to put in about half a day every day, or at least 4 days a week for this process, you might be doing it in a similar speed or efficiency to what an intermediary would do. Otherwise, just add the days. If you do it half a day or 1 day a week, you are just expanding the time frame substantially. The other thing that is different is follow-up. Think about it, the way you address your customer calls, complaints, or inquiries. You have a team of salespeople, whether it's yourself or otherwise, expanded group, and you should to respond immediately. People leave meetings, people leave whatever they do if a customer is on the line or just stepped into your place of business. If you take the same approach to addressing buyers, then you're not going to take longer than an intermediary. But if you don't, you are going to lose some of those buyers. And if you don't lose them, you are at least getting them to feel that this is not a priority for you.
So we'd like to thank you all for participating. We'll let you know and keep you informed of additional webcasts that we have planned. We actually have at least one per month, sometimes two per month coming up, covering the sections of buying a business, selling a business, acquiring a business, looking for acquisitions for your current entity, and matching your business to strategic investors or private equity firms to help you grow the company. So again, thank you very much. We're Navocate Business Sales and Acquisitions, and we look forward to speaking with you in the future.